But I'm very happy to have you. We had last week our first webinar on philanthropic impact investing with Peter Wolfley, and we have today really the privilege to have Jean-Philippe Schrevel with us to talk about financing the SDGs. So it's really, I think, an important time to continue talking about how we can mobilize capital to spark social innovation. There are a lot of talks right now. There's starting to be talks about the recovery, and especially about how we build a new normal. If you read, there's a new coalition of corporates and governments and ministers talking about the green recovery and how do we build a different way once we start reactivating the economy. So I think there is a perfect timing to start talking about the SDGs and to understand how the SDGs are actually a very valid framework to think about what is possible and what is new, or how can we go back to continue the Agenda 2030, because there have been a lot of talks that maybe the COVID crisis or the coronavirus crisis could delay the achievement of the SDGs. And there are also some talks that say that the current new normal can actually speed them up. So we have the honor and the privilege to have JP here. He's the co-founder of Blue Orchard and the founder and managing partner of MMB Capital, and he has worked with these institutions that deployed more than $400 million in emerging and frontier markets to date. So I think there is no better person to help us explore how we can finance the SDG and actually build win-win solutions for private capital and corporations. So last week we presented, and as you know, this is a series of webinars that will happen every Wednesday at 11 a.m. So we started with philanthropic impact investing, and today we are getting to the heart of impact investment and this idea of impact first. And we talked a lot about the key components of what made an impact investor different of a commercial or a traditional investor. All investment has an expectation of returns, and we will see how do we understand this in terms of impact investing and SDG investment in particular, but also this idea that impact investors have an active intention to achieve a measurable impact. And again, for precisely that reason, I cannot really think about a better framework or a better focus that talk about SDG 500, and JP will talk about this initiative. It's actually a groundbreaking impact investment platform, especially dedicated to financing the SDGs, the Sustainable Development Goals. And obviously, as the name is almost self-explanatory, but the objective is to raise $500 million in 6 different funds to invest in emerging and frontier markets. And I think it is a very interesting, because it's a collaborative type of solution and really is trying to bridge the missing middle that we talked a bit last week of philanthropic impact investment, and really focus on SMEs and bridge that gap between seed money at the early growth or growth stage of businesses in emerging economies. And so why, and just a brief introduction to SDGs, in case anybody or any of you is not familiar with the SDGs, probably not. As you may know, SDGs are a kind of, I would say, or maybe it's wishful thinking, but I think it is a global framework that has been adopted by public sector, but also private corporations, or how can we reach the kind of society, if you want, in general terms, that we want, and we will talk in a minute. But I think the very interesting part of this framework is that it's not only these 17 goals, but it also has 169 very specific targets that actually are opportunities or investment-ready opportunities. And there's been a study done by UNCTAD some years ago where it's shown that there is at least a 2.5 trillion investment gap between the public money and private money if we want to achieve the SDGs in emerging markets by 2030. And that investment gap actually represents around 12 trillion economic opportunities. So what are the SDGs? And if you look, I chose a couple of them: zero hunger, good health, quality education. This first part is really what, for most of us probably in this video conference, is something we take for granted and we have access to, but it's really related to basic needs. You also have SDGs that actually target equal opportunity. Not everybody has the same access to achieve these SDGs. We have inequality, gender inequality, and poverty. So if we want to achieve it and bring equal opportunities, we also have this side part on the SDGs. We also have some SDGs for those that want to focus on changing the way we're producing and consuming in order to live inside the boundaries of what the planet can allow us, and how we can rethink affordable energy, climate action, life on Earth. So really to have a healthy environment. But we also need a healthy society and a healthy and opportunities of decent work, infrastructure, sustainable cities. And I think last but not least, and it's something we have seen lately, is the importance of institutions. Many of the global institutions have been the peacemakers of the last 50 or 100 years, if you want. How do we keep them? How do we keep talking about democracy when we see that there are a lot of questions about it? And how do we work and build a just, transparent, and peaceful system in collaboration? So I really think the COVID crisis is a good example to build on, and we will talk even beyond the COVID crisis with JP. And if you think, for example, there's a lot of now press or on the needs for masks or protective equipment, ventilators. Obviously, we can tie that to SDG 3 and companies that are starting to build these kinds of needed goods. But if we cannot talk about masks and protective wear and ventilators without understanding the need for infrastructure, where are all those masks and where are those hospitals? One of the things sometimes that talk about Germany that has a lower death rate for COVID is because there's a surplus of beds, at least what it was saying on the news. I don't know if there is a surplus, if there is lower death rate, they may have the right amount for the necessary things. So what happens with the infrastructure, especially in emerging economies? But we can give protective goods, we can have better infrastructure, but if we don't have a qualified personnel, doctors, staff, paramedics, enough people specialized on infectious diseases, on pulmonary diseases, etc., obviously the results are not going to be the same. And there is also, if you want more into decent work and also the combination of technology, if you want more granular, 8.2 talks about how do you include, and there are a lot of companies now talking about robotics to minimize the impact on those health workers that are in the front line. How can you include technology and also in emerging markets? I lived in Peru and I'm originally from Argentina. So you can have, again, these 4 things that I mentioned before, of 4 SDGs. But if you don't have a steady energy supplied, if you don't have access to an energy supplied or clean water and sanitation, obviously the impact of having masks and protective equipment will be much lower. So this is what I liked a lot, this idea of bringing as our first part of talking about impact first, impact investment with JP, this idea of systemic thinking and how the SDGs can bring this about. So really the aim of all these webinars is how we can mobilize public or private capital to create a more just, inclusive, and sustainable world. And I think the SDGs are actually absolutely a perfect example for this. So without any more introduction, I would ask you, JP, please, can you introduce us a little bit to Bamboo Capital and what are the key trends that you see on impact investment. And thank you for being with us today.
It's a pleasure, Vanina, and good morning or good afternoon to everyone. First of all, thanks for having me, and I certainly hope that all of you are doing well as your families and loved ones in those crazy times. And thanks for making the time. So I'll try to be very synthetic, Vanina, and if there's any question, of course, I'm open for questions and Q&A, which are usually the best part of those webinars. So, since I started 20 years ago doing impact investing, obviously a few things have changed. I would say, number one, the interest from a multitude of new actors coming to the field of impact investing. Back then we were probably 3 or 4 impact investors. Today, I think you count them by hundreds. That's very encouraging. Number two, I would say the interest not only from the social or development actors, but also from the mainstream finance. And we see an increasing interest from professional commercial investors, big houses, big private equity houses, large banks coming to the sector and realizing that this is something that they should be focusing more in the future. I would say another trend I'm seeing, and that's a major one, it's a shift of wealth from an old generation to a new generation for the millennials, and then we'll have the generation Z, and then we'll have other names, but clearly new generations requesting purpose with profit and pushing their banks and their money managers to integrate new dimensions than just the financial return in their portfolios. And that's a major force at work right now for good. And then I would say last but not least, the role of technology, increasingly so in our portfolios and in our companies in which we invest, and as a support for a larger scale of impact, faster deployment and growth. And why? Basically because technology enables two things. One is obviously the accessibility to the services we are providing to the masses of low-income people, and second, the affordability. So if you combine accessibility and affordability, you suddenly have disruptive business models that can trigger access to essential services worldwide, and that's a force, again, for good. And then probably last one, if I may, is the increasing recognition from the public sector and governments that SDGs will never be funded if we don't call in or if we don't attract the private sector. I mean, you can dedicate as much as you want of your GDPs towards the SDGs. The numbers you have shown when you started, Vanina, are just mind-blowing. And there's no way any public aid to development will ever meet those targets. So we need the private sector. And there's now an increasingly interesting form of combining public money, philanthropist money with private sector. And that's what is called now blended finance, that is being structured from, products that are now called structured finance products. So the combination of the realization of the need for private sector by the public entities, push for increasing number of public-private partnerships, and this is done through structured finance or blended finance. So I'll stop here, but those are the major forces, in my opinion, at play today that brings impact investing clearly at center stage and front stage of what's happening today. And the COVID crisis is really a revealing factor of that.
Great, thank you, JP. Let me remind you, remind the participants, the audience, that you have at the bottom of the screen a Q&A part. If you want to ask specific questions, you can write it in the Q&A and I will ask JP too. And you can also put a vote if somebody else asked a question that was interesting that we can add. So since you're mentioning the importance of blended finance, of this combination of public and private and philanthropic money, can you tell us a little more about what is SDG 500? How did it come about? What is the aim? and how you're putting this idea of blended finance to practice now.
Sure. So SDG 500 is the result probably of 2.5 years of work, during which time we developed 6 impact funds, each according to a structured finance approach and a blended finance approach, and each with 1 or 2 key partners from international organizations or the UN system. And I won't go into the details of all the funds, but just to briefly mention them. We have a fund going with called the ABC Fund, which is a fixed income, so a debt fund, open-ended with no life limitation, that the International Fund for Agriculture Development sponsored, and we were selected as the manager of that. We are going to target smallholder farmers, smallholder farmers cooperatives, mostly in Africa, with that fund. And we do that with a partner, not only IFAD, but also the government of Luxembourg, the AGRA NGOs, the European Union, that's been a big anchor investor in that, and our partners in West Africa called Injaro. The Build Fund is actually also a debt fund, also open-ended. And with this fund, we are going to lend to early-stage companies, SMEs, in the least developed countries. And that's a fund that was sponsored by the United Nations Capital Development Fund, and for which we have been selected as a fund manager. The CARE She Trades Fund is a gender fund, built and structured in partnership with 2 organizations, one being the international NGO CARE USA, and specifically their subsidiary called CARE Enterprises, and the International Trade Center, and specifically their She Trades program. And here the fund will be investing both equity and debt in companies that are either women-owned, women-led, or that would target a specific need of their women clients, and will start with Southeast Asia as a target for the geographies. Block Smart Africa and Block Latam are 2 technology-based funds. Basically, as I mentioned, the role of technology in access to essential services is increasing by the day. And we want to have 2 venture capital funds, one in Africa, the other one in Latin America, that will focus on investing money, purely equity, purely venture, into early-stage tech companies that are using technology as a disruptor and a new way of creating business models to deliver essential services, such as financial services, access to clean energy, access to education, access to healthcare, and food security. So we do this with an alliance in Africa called Smart Africa. That's an alliance of 30 African states that are pushing for the creation of a single digital market in Africa. And that's very fascinating because they're equipped with lots of incubators all over the place. And then last but not least, the HEAL Fund is the healthcare fund. We'll be launching in partnership with the Stop TB partnership hosted here at the UNOPS in Geneva. And the purpose of that fund will be to invest as well venture capital into early stage companies, health tech companies, but taking a coherent ecosystem approach to investing, very much like the different goals that you mentioned, Vanina, on your SDGs. Yeah. Everything is sort of interconnected, and if you only tackle one piece of the puzzle, you don't bring any solutions or lasting solutions. So you really take an ecosystem approach to solving access to, primary and secondary healthcare, and that's what we're going to do with HEAL. Now, at the end of last year, Vanina, everything came together. And we realized that we had actually 6 amazing impact funds that mostly, when you accumulate them, touch almost all of the SDGs. And we said to our partners, we believe that here we have a unique historical opportunity to partner SDG 17. Let's come together and let's present to the private sector investors, impact investors, an opportunity that is sizable, $500 million. And that is de-risked and protected because, this SDG 500 is structured in such a way that there's an opportunity for about $360 million of senior tranche investment. That is an investment that private sector can make to get their returns, have an impact while being protected by $140 million of public money, taking the first losses, the first hits on the portfolio if there are any. So I'll stop here, but that's the goal.
That's a very interesting side of the blended finance, no? The de-risking side from the public money. And I have a couple of questions. I have Martin actually asking if small-scale investors or individuals can invest in the SDG 500, and how do you engage with investors to join the fund?
So that's a good question. Unfortunately, we are a regulated asset management in Luxembourg, and those products are so-called only available to qualified investors. So this is not, unfortunately, a retail product that we can sell for small-scale investors. Minimum ticket size of investments is about $1 million. Now, this being said, if your bank is interested in that product and is willing to actually represent you and pool many of their small clients into one single investment that they would make on your behalf, then of course that's possible. But as such, the fund is not open for retail investors. It's open for sophisticated, qualified institutional investors or large family offices, private banking clients, ultra high net worth individuals. And that's because of regulation, not because we decided to do so.
There are a couple of questions on the other side, on the entrepreneurial side, and there is one question from Anne that one of the problems with the missing middle is usually the cost of a due diligence. How are you using technology, or how are you doing to allow this investment that are smaller ticket sizes on SME? So I think, what is the role of MMB Capital on that?
Yes, that is a very good question, and actually one pointing me towards the strength of the blended finance model that we have approached. You see, if you have a first loss tranche in a structured finance product, in a blended finance product, that doesn't request returns, right? It's public money that is being catalytic of private sector. This means that the weighted average expected return of your fund is lower than if you didn't have a portion of it not requesting returns. That allows you to do two things. First, to pay a return on the senior tranche investors that are protected, which is lower, but on a risk-adjusted basis, this is very commercial, right? They are protected, they earn less, but when you take a risk-adjusted view, they get a market-based return. Now, at the same time, this allows us to become an investor in the missing middle, because we can go earlier stage with smaller size tickets, because we can take more risks, and we can, if you wish, expect probably a lesser return while taking more risk. And that's allowed by the first loss tranche that is given by the public sector. Now, of course, you see, Bamboo is a company that has 32, 33 staff. We have offices in Singapore, we have offices in Nairobi, we have offices in Bogota, but we don't have offices in 80 countries. Now, when teaming up with the United Nations Capital Development Fund, with CARE USA, with Stop TB, with Smart Africa, with International Trade Center, suddenly we have a presence on the ground in 90 frontier and emerging markets, with hundreds of staff working for those organizations, which are our partners for the funds I just mentioned. So when it comes to monitoring, deal sourcing, finding opportunities for investment, monitoring the impact that is generated, reporting on the impact, the partnership model that we have structured with all those agencies that are doing that anyway for a living, and because it's their mission, is brought together with the strength of a pure, if I may say, financial investor, for-profit private investor, saying, let's team up and give the best of each to this partnership. You're on the ground, you source deals, you check the impact, you monitor them, you report on it. We will be the portfolio builders. From what we see that you show us, we will select, we will due diligence, we will structure the investment portfolios so that First of all, we can get the returns of the senior tranche investors that we promised. This is our fiduciary responsibility. And at the same time, we don't want the public money to lose their money. So we want to preserve the first loss tranche as much as we can. So what we have built here, Vanina, is, in my opinion, the best of both worlds coming together. It's the UN agencies and international organizations with their mission of development and boots on the ground and expertise, right? And their sourcing abilities coupled with the rigor and the strength and the financial discipline. That should be attractive for private investors.
Great. Excellent. I think I really find the alignment of the different incentives to actually multiply the impact and the financial returns very powerful. And we will have a couple of webinars talking about blended finance too. Virginie has a question. So we have established this risk return profile of why this should be attractive to any commercial investor or regular investor, with the obviously the intentionality and the impact. Virginie is asking, since the recent interest of traditional private equity on impact investment, how can we make sure that the impact thesis still goes first and is not lost through the partnership with these investors that want to maximize return? And do you see a risk of cherry picking really and neglect some SDGs and not the others? Or is this a difficult subject to deal when you work in the collaboration?
No, I mean, first of all, I don't think so, because each of the funds, as I say, there's a specific partner that will have at heart to make sure that the mission of theirs is actually preserved and the fund is actually delivering on what it pretends that it will be doing, which is delivering impact on a specific sector, right? Healthcare, technology, gender, smallholder farmers. So there's no way the manager, that is us, can deviate from the investment strategy that is literally in the founding documents of the funds. So there's no mission drift possible from the manager. And when you ask the question, are the investors in SDG 500 capable of changing that? No, they are not. So either they like what they see at the beginning, which is the investment strategy, the forecast, the perspective of the financial returns, the missions of the 6 underlying funds. Either they like it or they don't like it. If they like it, they invest. And of course, we'll deliver on what we promised and what we shared with them. But it is not that they have the power of telling us we should do something else. They are completely informed at the beginning, and then we go. And our partners and the way we have structured our partnerships will make sure, even though there's no reason why we shouldn't do it, but we'll make sure that we don't deviate from the impact mission. We haven't done so in the past 13 years. I don't see why we should start doing it.
Good. So just to go precisely a little bit more on this impact, because we have a couple of questions from different people also about the impact side of the story. So why such a fund would be attractive? We know now why it's attractive in terms of return risk profile, and what would be attractive in terms for investors looking for impact, and how do you measure that impact?
Sure. So there's no one size fits all in impact reporting and performance, right? So each of the funds that is composing SDG 500 has actually what is called a theory of change. That's a very detailed description of why we believe that investing in specific companies will unlock bottlenecks or change situations that will improve people's lives, right, in the sectors that each of the fund targets. And this is something that has taken a long time for our team and our partners, putting their heads together to get a very detailed, actually, for each of the funds, theory of change, and based on this theory of change, impact metrics that will be measured and reported on a quarterly basis. So I don't have the time to go through, the 6 theories of change, but this is something that, of course, is readily available for our investors and in our data rooms, as we say, meaning that if an investor wants to understand what impact we believe we will be delivering, why we believe that our investments will actually trigger this change, and how it's going to be measured and reported on, it's all there in the data rooms, and of course, we are. I will be very. Then we need to be humble as well. We will keep learning as we do, right? We will never pretend that we have the magic solution and that we're perfect. Over the last 20 years, I can tell you, I've gone a long way, and I've learned a lot, and we have collectively learned a lot as an industry. There has been some standardization brought. There has been new refining to the definitions of what we should be measuring and where and how. I don't pretend we have the perfect solution, but at least the intent is there, the basis is there, and I think it makes for a very coherent framework.
Right. We have James and other people also asking more specific questions about operations and what regions you work. And James is asking, for example, that Care and She Trades is an Asian-based. So do you expect this to grow into Africa, to female entrepreneurs in Africa? So in what regions do you operate, and how do you make those decisions now?
So first of all, Bamboo has always only worked in emerging and frontier markets. Okay, so we are not a US investor or a European investor. We are emerging markets. That's number one. Then, as you will have understood from the 6 funds that we have structured, some will target specifically Africa, some will target specifically Latin America, some will target specifically Southeast Asia. One of them will be global, that's the healthcare. And that brings me to maybe one element we have not mentioned yet. SDG 500 for us is not the end, it's just the beginning, right? Mm-hmm. SDG 500 has today 6 funds and key partners in each of the funds. Obviously, what we believe is the beauty of SDG 500 is that it is scalable. My dream is in 2 years' time, go back to Davos and at the WEF and say, hey guys, now it's SDG 2000, right? Mm-hmm. And then to bring on board new partners, new UNJ agencies, other international NGOs with new dimensions. I mean, we're not covering land, reforestation, conservation, water. I mean, those would be great additions to the next platform.
There are also a couple of additional questions on impact measurement, standardization, and David is asking, you mentioned 6 different theories of change. How do you ensure consistency? And there was another question now, sorry, I lost the name. The chat is going really fast, so that's good. Are there certain standards that you follow in this measurement, in the reporting?
Sure. All the measurements are following the IRIS metrics. So this is something that has been standardized. It's so-called, I would call it the dictionary of the impact investor. And we're using the dictionary to actually speak with the correct, precise terms whenever we seek to mention something. On the coherence, I think the framework is really SDG, right? So This is an SDG 500. You explained that there are 17 goals, but below that, you have many more very concrete actions and objectives for SDG 500. I mean, for SDG 7, the 17 SDGs, and SDG 500 is clearly, tracking impact on a fund-by-fund basis, but in a coherent and comprehensive framework, which is the SDGs.
Good. I have here, let me see, another question on this idea, impact first, finance first. Sorry, I lost just 2 seconds ago. How do you think is the best? No, sorry, this is a different one. How do you think is the best way to tackle? Are you doing anything on enterprise building, on management skills with the SMEs that you're working with, or you're already working on a side of the spectrum that are already ready to scale?
Yes. So as I said, the attractiveness of SDG 500 is that we can go to the missing middle and go early stage with those companies. The other very good advantage of working with UN agencies and international NGOs and all the partners we have is that they can bring technical assistance facility, right? So most of the funds will be equipped with a TA, as we say it, a pocket of money that will be directed to the portfolio companies in which we're investing, and will clearly be a great source of help to, structure better prepare better, equip better the portfolio companies for success in their growth.
Good. They're also asking that a lot of the money on impact investment is going to middle income countries. Do you go to lower LDCs or lower income countries? And how do you manage country risk or political risk?
Yes.
Is that something you include in your decisions?
So number one is we have no exclusion list, except the ones that are official from the UN, obviously, or international organizations. One of the funds actually is pushing us to go to the least developed countries, what we would call the frontier markets, and that's the United Nations Capital Development Fund. That's their mission. It's how to promote SMEs in the least developed countries. So I think that answers part of the question. The other funds will also be contemplating frontier markets, not only the middle income countries at all. I'm thinking about Latin America, for example. I mean, we will not only go to, Vanina, to Peru and Colombia and Mexico. We will go also to other countries in the region that really need that money, with SMEs in early stage that really need that money.
So, you have a very interesting pipeline in Peru that I've seen. So
yes, we do. But answering the question, yes, we'll go also to least developed countries and frontier.
So they're also asking to continue that impact investment has been growing and there are more and more firms interested on this field. Have you ever faced, and Manu is asking, competition in this field? And there was also another question, do you collaborate with other impact investment
yes.
that operate in the same ecosystem and in the same region that you work with?
Okay, well, it's two sides of one same question, right? For me, there's no competition. I mean, come on, look at the needs. Look at the size of the problem we're trying to tackle. The more, the better, right? So there's no competition as far as I can say, as I can tell. I think we each have our own approach, our own ways of investing and doing things. But in the end, we're pushing all in the same direction, right? And the SDG actually is giving us a global framework to work together towards. Do we collaborate? Yes, we do. We co-invest with other investors, impact investors. We have industry discussions. We have specifically also on the social performance. For example, we're part of the social performance task force. We're part of the Financial Inclusion Equity Investors Association, and this is really where, at industry level, we share best practices, problems that we have faced, issues that would go beyond just your own little shop, but that actually are very valid questions to be debated at industry level. So yes, we co-invest, we share lessons. Actually, we are about to release our last impact report, hopefully this week or next week. We see that as a way also of sharing lessons and showing what we're doing, and being open for suggestions and comments, and always seeking to improve. You see, three years ago, Bamboo really repositioned itself as a platform open for partnerships, as opposed to this inward-looking model of growing internally, fund 1, fund 2, fund 3, and those are my funds. Here we are really willing to share what we have learned over the last 20 years with newcomers to the field of impact investing, so that they don't do the same mistake that we made in the past. And this is how actually SDG 500 came about. It's really
I lost you for a second. I don't know if I went. Okay. Good. I have an additional question from Tom, and I had a couple of questions before. Is there really too much capital? Is it easy to source, or the too many? Because entrepreneurs tend to say that there's enough money, and investors tend to say there's not enough investable already opportunities. So how do you see this evolving?
That was a debate a couple of years ago on microfinance, and the title was Water Everywhere and Not a Single Drop to Drink. And that's exactly the same thing. I see that there are lots of opportunities for investments. I am not worried about the pipeline of investments. Of course, we need more, and we need more growth, and we need more enterprise creation. And that's why all the work that UNCDF, for example, is doing by helping early stage SMEs in emerging and developed, at least developed markets is really essential. That's number one. So we need to keep nurturing and developing absorption capacity by creating companies in emerging markets, but that's not where really the bottleneck is today. In my everyday life, an SDG 500 model is very sexy, very exciting. I see it, we see it as the way to go. We have not raised it yet, right? And this is where the rubber hits the road, right? And where investors have to switch from nice words and intents to money and check writing.
And I think in that point, I think oops, my chat something disappeared. On that take, a lot of people are also asking how the COVID crisis is going to affect. Do you expect that you will need that investors will need to adjust their returns expectations? Or what do you think are the impact now? And there is also a question there, if you have a fund that is focused on health, and how is COVID affecting, and what are you doing on that spectrum?
Okay, well, that's of course the multi-billion-dollar question, right? I do believe that, first of all, of course, with our existing investments, the COVID-19 will impact, first of all, in the way our companies are being organized, right? I mean, we need to take care of the health of the employees of the companies in which we have invested and their clients. And that, of course, triggers a lot of operating changes, and that's not a surprise. Number two, since we are, through our portfolio companies helping low-income people, obviously, the extent of the damage, economically speaking, will depend on the level of, impact of the health crisis on this population, and it can be relatively important. So we will probably see a downturn in or slowdown of the growth for sure, and maybe a downturn on the economic results of those portfolio companies, at least for the next couple of months. That's for sure. But that brings me to something that is, I believe, very, very important to realize, is that, yes, there's a healthcare crisis, there's a sanitary crisis, but very soon after, there will be an economic crisis. And when you look at our world, and certainly in frontier and emerging markets, the backbone of those economies are the SMEs, the small companies, the low-wage workers. And if we're serious about having those countries, that's certainly not the time to, scale down investments for impact and help for emerging markets. To the opposite, this is the precise moment where you should actually increase your health, because otherwise the backlash will be severe. Now, on the SDG 500, there's always the temptation from governments to say, "Oh, but I thank you. This is really exciting, Jean-Philippe, but we'll get back to you in a couple of months when we have sorted out our problems at home," because we're being hit hard. So I'm really calling on those guys and public officials and governments to actually think a bit further than the next 2 or 3 months, and realize that they shouldn't throw the baby with bathwater, and not undermine the very fundamentals that will allow a fast, or as fast as possible, recovery on the economic front for the poor countries and poor populations. And same thing for the investors. I mean, guys, there have been some stories and studies actually after the 2007-2008 crisis from well-known houses and consulting companies saying that those corporations and investors that went out of their way to invest at times of crisis are actually the ones faring better in the next decade. So I stop here, Vanina, but I do believe that in every crisis lies an opportunity, and you would better take it now.
So I think if probably talked in the past about governments investing trillions to support SMEs or workers or the health system, even 5 years ago would have been impossible to think about, and we are. So I hope, as you're saying, also the mindset stays there. Can you elaborate a little bit on this role of corporates that you mentioned, that companies that have invested during the global financial crisis and during the recessions, to see what is the role of corporates
yes, I think,
in the recovery?
Sure, I think corporates, of course, are a huge, important factor in the recovery and in what we could do actually with impact investing. I mean, some corporates are busy doing their own impact investing with their own internal venture fund, and I think that's great. I think they would benefit a lot if they were collaborating a bit more with external parties. For example, offering co-investment opportunities, offering more than just money, but the talents of their employees. I do believe that corporations have a lot to gain, not only economically because of their stabilizations or their improvement in their value chains in quantity and quality. It's also positive for the corporations in terms of possibly market intelligence. It's positive for corporations in terms of maybe spotting future potential acquisitions in such pipelines. And last but certainly not least, I do believe that employees of those medium to large corporations would be thrilled to see their company, active in impact investing and allowing them to actually benefit from an exposure to them and an opportunity to contribute both financially. Why not asking all the employees of large corporations to, invest in a corporate fund? And number two, they are all, very talented individuals that have know-how and expertise that could be put to use in portfolio companies, in impact investing portfolios. So I do believe that corporations have a potential role to play in investing, right, offering co-investments, strengthening their value chains, opening their value chains, and having their employees participate.
So I take advantage and I pass a little public cherry here. The next webinar we have on next Wednesday is Fabio Segura is actually working on this venture, investing with almost 80% of the corporates in the cocoa sector now. And we'll also talk about blended finance solution, collaborative blended finance solutions. So if you're interested today, please join me next week. And to finish up, I want to share first with the audience a little poll, and so we get some feedback. So what do you think, what is the opinion of all those 130 something people that join us today? What is the value add of blended finance? A better risk return that we talk about, the lower cost of capital, enables multi-stakeholder collaboration, allows to scale. So what do you think it is? So let me show the results. And I think it's been quite, so most this allows to scale impact. And I find this answer very interesting too, because I think we know in this field how to finance impact, but it's been really hard after these 10 or 15 years to scale up. And I think this fund and this platform, I think, has that interesting feature. And also enables multi-stakeholder collaboration, better risk return, lowers capital. I think a little bit of everything. And I think 25%, all of the above. No, I'm glad that not everybody put all of the above, because it gets very boring when people put all of the above all the time. No, but I think we find a very interesting result. So if you have, just to finish up, what would be the key takeaways that you want to share with us? Because we have a couple of minutes, and if you have any last minute questions you want to add, please, people, audience, write it on the Q&A. But what would be the key lessons learned in your career, if you want, about this field? What do you want to share with us?
Thank you, Vanina. Well, it's been a pleasure, but maybe a few remarks to finish. It's been 20 years, and I've learned a lot, and I'm still humbled about what I see and discover every day. what I would say is, and we've done a lot, right? I mean, we've done many new products. We've broken many new grounds. I think one thing that I still have to learn is patience. And whatever you plan for, you should know that it's going to take longer, whatever you do. Even if you work 24 hours a day, weekend included, it's never going to go fast enough. So that's one. So take a long-term perspective. And number two, what I realized when engaging with large corporations or large organizations or large, banks is that the institution itself will not move unless you have courageous risk takers, champions at the highest level possible. And SDG 500 would not have existed without having spotted at least one or two champions in each of our partners. And they have been absolutely key and instrumental in doing that. So if you are inside a corporation, you can change things. You can make a difference, a huge difference. And it's becoming a champion for a cause you believe in and using the strength of your corporation or organization to actually achieve them in a cooperative mode. Never mind, you will always face people that believe in the past and don't see any personal interest in changing things. Just don't listen to them. One thing that is maybe on the pessimistic side, when talking to investors, despite all the rhetoric of let's help the world, let's change the system, it very often boils down to financial returns. So whatever I believe we will be looking at building in the future, like the blended finance, like SDG 500, it has to make sense for someone that will only look at this from the financial angle. Otherwise, you're not going to scale, impact, and that's what we want. So unfortunately, people will still look at their portfolios and returns and will not trade off. So that's a lesson that I have learned. I believe in a more human financial system, or in a more open-minded and brave new world sort of impact investors. It does exist possibly in some exceptions, but it's not the rule today. Maybe we can change that. We'll see. In that vein, very often a good excuse for not moving or investing is the so-called fiduciary responsibility of the gatekeepers and the board members. And I tend to believe that it's a very easy excuse for not doing anything, and that actually fiduciary responsibility of investors is to go beyond their yearly results or 5-year plan, but look at the future of mankind and look at the future of our planet. And that's clearly should be written in their fiduciary responsibility of investing. Another one, and then I promise I'll stop here, Vanina, but another one is really that the financial system probably will not change by itself, but it's only because of pressure from their clients and their users that they're going to move. We see now this happening because of the millennials requesting products and investments in their portfolio from their banks. It's not that the banks came up with a great idea, let's save the planet and let's save the environment and here are products to do that. It's because it needs a request and a need from their clients, without which they would be losing those clients. So any pressure we can put on the financial system from the users of this financial system is the best pressure ever you can think of. And last but not least, never give up.
Thank you, JP. And I think it's the perfect, I would say, ending for this webinar is to call on all of you to become these courageous leaders. And also, I think part of the aim of these webinars is this idea of a changing financial system that finance the future. And I think there is more and more talks about the fiduciary duty and the stakeholder capitalism and integrated reporting and how we underprice risk. And if something this COVID crisis can tell us is how systemic risk needs to be included and environmental risk be included, so we don't have the next crisis being a climate crisis of the levels that we're having today. Thank you very much. It's been really, really a pleasure and an inspiration. And let me share with everybody a little bit our context. Again, next week we are going to have another webinar on blended finance and a solution specifically for SDGs. And here you have Jean-Philippe, because there were some that were very specific questions, contact. And here you have my contact. You're free to contact me on LinkedIn or on Twitter or on my email. And thank you very much, JP, for your time and this webinar, and count me in as a partner in crime in whatever you need. And thanks everybody for your lively participation. And I apologize if I left some of the incredible amount of questions that were going into in the Q&A a little bit on the back burner. But thanks so much, and see you, I hope, all next week, Wednesday, 11 a.m. Central Eastern Time. So thanks so much.
Thank you, Vanina. Thank you, everybody.
Thank you, everybody.
Be well.